For a closer look at how these tariffs and threats are impacting the markets, let's bring in Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley, and Russ Koesterich, Global Allocation Portfolio Manager at BlackRock. Morning, guys. Good to see you both.
Good morning.
Russ, we've been here before, several times, in fact, since the January peak, where trade tensions rise, big gap down, industrials and multinationals sell off. Is there reason to think today's chapter in the playbook's different?
Well, I think there are a couple things that are different. We're a little bit further along in terms of the tit-for-tat trade dispute. I still think at the end of the day, our base case is it gets resolved, but clearly it's gone a little farther than the market would have thought. The second thing that's a bit different is financial conditions have tightened. We've seen a surge in the dollar. The Fed continues to nudge rates higher. Now, generally, I believe that financial conditions are still mostly accommodative, but any of these issues becomes a bit more acute, a bit more serious when it's happening in the context of tighter and more expensive money.
Yeah. Mike, you've got a note, and you talk about the fact that even though we've been, quote unquote, range bound for a while, you argue the market has taken on more risk than people realize in certain areas. Can you expand on that and talk about whether this week's action is sort of an offset to what some say has been peak sentiment, at least in tech, for instance?
Yeah, look, so I mean, this year is interesting. The NASDAQ has been the best performing index within equities, followed by small caps, then the large cap S&P, then you go to high yield, then investment grade, and then treasuries at the bottom of the list. So it's clearly a skewed market towards riskier assets having outperformed, and some of that's skewed towards growth, meaning the market is willing to pay for companies that can grow in any kind of an environment. So the presumption is that these tech companies aren't going to be wildly affected by trade, at least in the near term, and the earnings trajectory looks quite good. Same thing for small caps. But that's gotten pretty extreme now. So we did write a note yesterday saying maybe this is a time for a little bit of a reversion where some of the riskier stuff comes back in, and we upgraded utilities as part of that. I would say, in addition to Russ's comments, what's changed is we're getting closer to the midterm elections. And if I'm President Trump and I'm looking at how the markets are reacting to this, it's kind of a win in many ways. The S&P is flat for the year. The Chinese stock markets are down quite a bit. And so there's actually kind of a positive feedback loop in that regard. And I just don't expect the White House to back off here as we go into midterms. That's probably the biggest risk, is that this is a political gesture as much as anything else.
Russ, you talked about us being farther along in this process. Are we getting to the point where actually you can start to price in to earnings estimates, changes in earnings estimates because of tariffs? I mean, up until now, it's been mostly theoretical, except for solar panels and washing machines. But now, and we haven't actually seen anybody change. Okay, you know, we think Boeing's going to make X less because of, but is that what we're getting to, where you can actually start to see, okay, now we got to change either the multiple or the earnings, and that's a real effect on where the stock market is going?
I think that's fair, and it's happening in a couple of ways. First of all, we mentioned the manufacturers, and certainly the industrials are vulnerable. They're also, again, continuing with this stronger dollar. And then when you get away from the company specifics, the industry specifics, the other thing you've got to take into account is that analyst expectations, to your point, are still fairly robust. And that was premised on the notion that this year was going to be that global synchronized recovery. Now, we're already seeing Europe decelerate much more than investors thought. European economic data relative to surprises is the lowest we've seen since 2011. If investors start to call that synchronized global recovery narrative into question, then yes, I do think not only will you see downward revisions and questioning of earnings to more cyclical international companies, but to market earnings in general. And that is a risk for the market, particularly as we come into this seasonally weak period of the year, which, by the way, tends to be a bit worse when you have a midterm election.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.